Hey everybody, back with another ETF review, and today we're going to be looking at the iShares Select Dividend ETF, or DVY. Wanted to take a look at this ETF because still looking for a good high yield dividend ETF. We've seen some decent dividend appreciation ETFs, but most of the high yield ones we've been looking at have left us wanting, so maybe we'll find a better thing here. We'll start with just a quick description of what the ETF is. It is 100 stocks that have 5 years of paying dividends. It considers itself an income-seeking ETF, and it has a very vague investment objective in that it just simply looks for relatively high dividend-paying U.S. equities. Again, that's a little vague. I would be sure to read the prospectus here, see how they're selecting this companies, as usually they do kind of provide a little bit of their formula, what they're doing to select those companies when they give the description, so just be sure you look into that. As usual, we'll start by looking at the expense ratio, and currently it's sitting at about 0.38%, really right around the average for a passively managed fund, not one of your super low cost ETFs with less than 0.25% expense ratio, but also not one of the higher ones that get near those active expense ratios. So, nothing to write home about, nothing particularly interesting in terms of expense ratio. Just remember, it's going to be about $38 a year per $10,000 you have invested. Looking at the yield, currently sitting at about 3.5%. Very, very nice for a dividend ETF. A lot of dividend appreciation ETFs are anywhere between 1.5% to 3%. So this is doing better than that at about 3.5%. It's definitely not the super high yields that we've seen from some of the ETFs where they're at about 5% or 8%, but they also don't have much appreciation. So it kind of falls somewhere in the middle between those. But 3.5%, you're doing somewhere between 2 to 3 times the wide market, the S&P. So that's not too bad there. Taking a peek at the distribution history, we can see that it does pay out quarterly, and it has been paying out anywhere between really 80 cents to $1 over the last couple years. The distributions do seem to be increasing, not quarter over quarter, but definitely year over year. Going back, we can see that definitely as we've gotten up to this, $1, 80 cents to $1 range. Going back a couple years, it was well below that, sitting in the 60 and 70 cent ranges. So the distribution is definitely increasing. The underlying companies that it has, it is either turning over companies and getting companies with higher dividends, or the companies it's invested in are increasing their dividends. So it's good to see that your income, your distributions are going up year over year. Now let's take a peek at the portfolio and see what we've got here. If we go through, we can see here a lot of names that we'll realize: Altria, Philip Morris, Exxon, AT&T, IBM, Pfizer, Chevron, Valero, International Paper, Verizon, Lumen, even Seagate Tech. A lot of companies here, a lot of very healthy dividends. Some of it are a little suspect. You all know how I feel about Lumen and AT&T, but that's just 2 pieces of about 100 company pie. But we've got things like Seagate Tech. There's a 3% yield. Verizon, there's an almost 5% yield currently. International Paper, there's a 3.25% yield, I think. And then, of course, you've got your energy and your tobacco companies, which are all paying, healthy dividends over 4 or 5, sometimes 6, 7%. So it's definitely looking for yield here. The companies that it's picking, they are definitely on the higher yield side, as opposed to companies that are definitely going to increase their dividend every year. So just keep that in mind. You've got something like AT&T, which is going to have a dividend cut. You have something like International Paper, which has a dividend cut coming up pretty soon, actually. Or actually, the cut has already happened, and it's just waiting to go through for payment. So just note that when you're looking at with companies here, it's definitely looking for, it's prioritizing yield over dividend appreciation. So just keep that in mind. Going to the exposure, we can see that the fund is pretty much half utilities and financials. One interesting thing here is usually when we see these dividend ETFs, financials is the largest sector. In this case, it's utilities, which is just something interesting there. They're definitely focusing on utilities, which do have higher yields over financials very slightly. And then once we get out of these two, really, it starts to go down quite a bit. They're all single digit from there. That is a little worrisome, if there was, some kind of, financial meltdown and people weren't able to pay, their utility bills, suddenly half of your fund is going to be doing very poorly. I would really like to see the consumer staples a little bit higher. You guys know me. Materials I'd also like to see higher, as well as communication. A lot of companies in these areas will pay decent dividends. I'd really like to see this be a bit more evenly split, but we'll see how it's been performing to see if this has been worth it. Going on to the performance, let's take a peek at how it's been doing over the past few years. We can see that since inception, it's done about 8.5%. That is less than the wide market, so just keep that in mind. However, over the last 10 years, you'd have been getting a nice 13%. Over the last 3 and 5 years, not quite as good, but over the last year, it has performed well, as have pretty much all ETFs that have been in equities since the crash. So, it's been doing well, but so is everything else. Is that worth it? Would it have been better to be invested in something else? We can check that out. Going on to our back tests, we will start with taking our DVY and comparing it to a dividend appreciation ETF in what I would consider the gold standard SCHD, as well as a control of VOO, which is Vanguard's S&P 500. And as we can see here, DVY has trailed by quite a bit. You would have returned about 3 times your money if you had been in DVY, whereas you'd have gotten almost 4 times your money with SCHD and over 4 times your money with the Vanguard S&P 500. Note here that this is with reinvested dividends, so it has quite underperformed. The big separation really happened right here in 2019, and it had quite a larger drawdown. So yes, if you had been in the wide market or in a good dividend appreciation ETF, you would have been doing much better. However, this is not looking for dividend appreciation that much, and it's not the wide market. It is particularly seeking income. So let's do another back test with our same 3 companies, but let's not reinvest those dividends. Let's just do, just what the fund is holding. Now, what is interesting here is, again, you have underperformed, but if you were seeking income here, you still would have doubled your money while getting those dividends, those distributions every month. And your distributions would have been more than if you had been in VOO or SCHD. So if you're someone who's just looking for yield here, this still managed to return 100% over about 9 years, actually almost 10 years at this point, while you're still getting that income out of it. So that is interesting to note, that if you're not really seeking that appreciation, say you're retired, say you're someone who just really cares about getting that income, maybe you want to reduce your hours at work, you don't want to work that second job, you want this to be that income, then this might be something to look at. You're still going to be getting that growth. It's not going to be, you're not going to be tripling your money, but you still would have doubled your money. So keep that in mind. Now, let's do one final back test. We'll do just high yield ETFs here. Again, we'll have DVY. We'll put that up against the SPDR high dividend ETF, as well as the Wisdom Tree high dividend ETF. And we can see here that it has outperformed its peers over the last roughly 2 years. It was really just kind of matching its peers going forward up until 2020, but once the crash happened, it has started outperforming, not by a ton, but if you were looking for a high dividend ETF, this is doing better than a lot of the ETFs in its category. So again, keep that in mind if you're someone who's focused on income over appreciation. So when it comes right down to it, is this something you should be looking for? Do you want to buy it? From an appreciation standpoint, I really don't think there's a ton here. While the dividends are increasing, the distributions, I should say, are increasing over time, if you're a dividend appreciation investor, you'd do much better with SCHD, really. You'd be getting almost a third more, 33% better in return. However, if you're an income investor, if you're really just looking for that yield, but you want something that's also not just going to give you a yield while being flat, which we've seen with a couple of the ETFs we've gone over in the past, this might be a good choice. Again, over the last 10 years, you would have doubled your money while still getting that probably 3 to 5% yield, which is nothing terrible. Very nice there. If you're a semi-retired, retired person, or you're just looking for yield. So again, if you are a yield investor, an income-focused investor caring about those higher yields, this is definitely something to look at over the peers in its peer group. So just keep that in mind. I hope this helps, and thanks for watching.